U.S. markets head for a monster open in the first trading day of the year. Manufacturing data out of China and Europe comes in all stronger than expected, and oil soars to over $100 a barrel as the EU considers sanctions of Iranian oil and as Iran threatens to close the Strait of Hormuz. I'm Alex Steele, and the Morning Call starts right now.
Good morning. I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Alex Steele with The Street, and together we bring you the Morning Call. It looks like it's going to be a happy new year for stocks. Scott, we have futures up huge today. Have they cleared some key resistance levels?
They're getting pretty close. I would say Santa Claus set the table in the last 2 weeks of 2011. We talked on December 20th about that gap and go that ignited and put together a new confirmed rally. And today, it feels like the new money flows are coming in, and they're going to try and break us out of this macro wedge that's basically trapped us over the course of the past few months.
Now, can you trust this rally yet?
Well, I think a lot of traders are coming in that weren't here for 2 weeks and weren't working every day like myself. And you were there a lot of the time.
No, I was on vacation, but anyway.
Anyway, so what I think they're going to want to see is some commitment. So what I like to do is on a gap and go type day, you wait 60 minutes. Because in the first 60 minutes, you're going to see people try and short the up opening. You're going to see guys that are also long from December say, you know what, Google's up $10, let me sell some. The S&Ps are up 2%. I had positioned during December, let me sell some. And if the rally stays intact there, with some profit taking coming in and with some people getting short, then you know that it could ignite further. So after 60 minutes, if you could hold up, then I think you're going to see some other money come in, and that's what could lead to a strong close into the end of the day.
So let's go to the charts. I want to see what those key levels you're going to be looking at to watch, especially if you want to take some off the table and then buy it back later.
All right, so here's the S&P. So let me just show you a few important things. First, if you remember the low in October. Then we put a higher low in November, and we held that retracement number. Then we put another higher low in December. So what happened on that December 20th gap and go, that ignited the last move off of this uptrend. So the question was, can we get above this downtrend and start to ignite and go? So the last week of the year, we went above it and we hovered above it. Okay, so now I would say if we can get above this 1277 and hold above it in the first hour, at some point in the next day to 2 days, we're going to be contending with this 1292 that comes in. That's that October 20th high. And then I still think, we talked about what we could do for the first quarter. If we could clear and close above that 1292, it opens the door for that move to maybe 1320 to 1340 at some point in the first few months of this first quarter of 2012.
What's interesting, we were speaking before we got on camera, is that the first 3 months of the year, that first quarter, could be considered its own trading year. And I just wanted you to explain to viewers why you thought that might be the case.
Well, last year you had 3 different moves that could have made your year. From the Head and Shoulders top pattern that fell, the October 4th, bullish reversal. So now I'm treating this as a macro wedge that's igniting with new flows, and I want to see where is the path of least resistance. So first spot is 1292. And then if I show you on the chart, if we get above 1292, you can see 1320, 1340 going across, and that's a nice move to start the year. It might take just January, it might take the first quarter, but I think if you treat it as its own individual year, and book it, and then keep reevaluating based on the headlines, whether it's February when Washington has to meet again about the payroll tax, or whether it's the end of February, March, when all those nations have to talk about whether or not they're going to ratify the new fiscal plan from the summit. So I think if you take some off the table and you keep reevaluating and you stay actively investing, you could definitely outperform the markets, which is the way a lot of people did back in 2011.
And in the short term, I do want to point out that since 1928, Bespoke Investment Group says that the S&P has averaged a gain of 0.6% in the first trading week of January, with positive returns 65% of the time.
That's because everyone gets their new money for the year.
Right.
And like right now, we're kind of marked up. If they're lazy, they just allocate it really quickly. That's why you see all the new flows. So usually even the first 5 days of the year could be different than the whole quarter.
Right.
So it's like you have to really look at step by step based on your risk tolerance and the time that you commit to the market.
So being really flexible is key. So let's go to some of the sectors, individual ETFs, and see what the good moves are there. I want to start with oil. We have prices today popping over $100 a barrel. Now, this is a twofold, really. I mean, we have the EU possibly igniting sanctions against Iranian oil. Also, we're seeing Iran threaten to close the Strait of Hormuz, which basically we saw about 17 million barrels of oil a day come through there in 2011. So that would be huge. Is there more upside here? If we look at, say, the USO as a proxy for oil prices, can it really take off?
it looks like it can clear this upper resistance, and it's like a double-edged sword of oil. You know, maybe another $10, and you'll see some good action in the OAHs and the XLE and some of those stocks. But if all of a sudden oil really gets going and it gets above, like just say 108 to 115 and continues, then everyone will start talking about the psychology of what it's going to do to the consumer, that extra tax, you know, the extra expense. So right now, I think there's a sweet spot that if it continues higher, it'll be good for the overall market, but then if it gets too high psychologically, it could put some pressure on us.
And the USO has been performing better than the OIHs, the oil services, so is there a catch-up play here with the OIH?
Well, here's the first chart of USO. Okay, right now it's opening above this 39 area for momentum players. If it can stay above 39, it can continue. You could see probably 41, 42. OAHs has a lot of very fundamentally rock-solid stocks in there. We talked about it with Stephanie. We've talked about it with Jill. Here's that inverted head and shoulders pattern. Left shoulder, head, right shoulder. You know, a lot of people are in tier 1 trying to anticipate whether or not money will come here in 2012. I think if it gets above 117, the next spot to look at will be this downtrend at around 121. You know, if you can get through 121 and the market stays strong, no reason why you can't get to 132. So here's like resistance 1, resistance 2, resistance 3, and then we'll talk about some stocks along the way that will outperform because that ETF as a whole will move, but there'll be better acting stocks with it.
And we'll get to those stocks in just a second, but we want to stay on the ETF track here. Want to hit on retail near 52-week highs. Expectations are pretty high headed into December holiday retail sales. We saw the National Retail Federation expecting sales to come in just under 4%. They revised it upwards just under 3%. That's a big move. Is it oversold? I mean, is it overbought? I mean, is there too much positive momentum baked into the ETF right now?
Well, when you come into a new year, you want to see if money's going to rotate. If some strong sectors get weak, if some weaker ones get some attention. Right now, as of now, the RTHs are one of the best acting sectors. It's near the highs where you saw the OHs are, you know, in the middle of the area. So if you look here at the chart, you will see that, you know, here's that important level. This is right around 114. Okay, this uptrend's been intact. This one started back in August. Okay, didn't even get contended with. The one that started in late September, you know, stayed intact also. And now we're brushing up against this 114. I would say, you know, be a little careful, but because Thursday I think that those retail sales, but it gets above 114, you know, you're going to see some movement, and there are a lot of strong stocks in retail that I'm looking at. That I'm looking at these monthly charts and yearly charts. They've been in basis for so long, so if they want to stay strong, there is room to the upside.
But is there any bad news baked in that you see in the chart?
Is there any? Not yet. So if bad news comes out, then that's when, you know, it'll be one of those things where it's going to have to prove itself all over again. And I guess Thursday, you know, we'll get some of those numbers, and then obviously when earnings start coming out in mid-January.
Earnings season again. I can't believe it. All right, we're going to go to tech. We're going to go to the Qs. Scott, on average, the Qs have actually fallen almost 5% in the first quarter, and that's all the way back since 2001. So on average, the Qs do not look good in the first quarter.
Well, you know why? Because I think usually they lead into the end of the year, so some profit takers come in to the first quarter, so that's when money rotates, and then it usually does better. But this time, the Qs didn't lead the way. The Dow did. Okay, consumer staples and some of the industrial. So if you look at the chart of the Qs, you see a wedge that's just starting to ignite. Here's your overall wedge. Looks still good technically, even though it wasn't leading. You had your low in October, a higher low in November, a higher low in December. Now it's trying to break above this downtrend that the S&P already did. So I think it's opening right now, you know, around this 57. If it could close strong, you have, you know, your path of least resistance is to about 59. Okay, and then if you go to the monthly chart, you will see that if it does clear that 59 and tech gets a nice bid through earnings season, there's really nothing in the way up until about 70. And I think at some point the Qs might be able to get to this, you know, 70 or higher this year.
And very quickly, we have two more sectors we briefly want to touch on. One is the financials, one of the worst sectors in 2011. But Scott, you said you were long at JP Morgan, Bank of America. Does that mean the XLF can also expect a big bounce?
I don't think a big bounce, but some type of bounce. You know, the tax loss selling's over. You know, the sector rotation, people are going to try and buy them. You know, JP Morgan's chart actually looked, you know, really better to me going into the end of the year. But, you know, we'll talk about that after. Right now for the XLF, you go to the daily, you will see that, you know, it's hanging around. You have a set of higher lows in place. It's trying to get above, you know, this downtrend, so to speak. So if it could clear this pivot here of a 1321 and close above it, there is some room to about 14, and in that room you can make some money with some of the banks, but then we'll have to reevaluate there.
And last up, we're going to go to the XLI. It's the industrial ETF. Are we looking for a short-term bounce? We got better than expected PMI data out of Europe in December, and officially China's PMI was over that crucial 50 level.
Well, this chart looks very, very tight, and it acted much better. It was a little quiet going into the end of the year, but if you look at it now, it does look like there's a lot of room here. you're at a big resistance right now. If we could get above this, what is it, 34.50 and stay above it, there really is no resistance until about 36. So these industrials that have been strong, that you have your set of higher lows in place, if it closes above this area, shorts will be squeezed, and I think you have some follow through to about 36.
All right, and we'll be right back with some quick ways to make some cash on this Tuesday right after this, so stay with us.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
All right, let's get into some stocks you're definitely going to want to keep on your radar today. Want to start with Apple closing above that $400 level last week. Are we headed into some key resistance? I know you were long headed into today.
Yes, there's one more spot, this big gap up. I'm going to go right to the chart, take a look here on Apple. I am long some. I'm going to see how it contends with this 410. If it could get above 410 and stick above 410, I think you get a quick cash flow trade to close this gap about 415. If that happens, this island top is nullified, and then perhaps if earnings come in and they don't disappoint like last quarter, you're going to see new historic highs in the first quarter on Apple.
And what about Google? It's one of your favorite stocks of 2012. You said you were also long headed into today. Has it kind of hit some sort of resistance here, though?
Very short term, it's a little bit extended, but for the macro picture, the weekly and monthly charts tell me north of 750. It cleared 630, 635. That was my buy price, last week. I probably will sell some above this 650, but I'm going to try and hold some because I do think Google gets above 750 this year, but I will take trades along the way.
And Walmart is, speaking about retail, Walmart's near that 52-week high, headed into retail sales, and we were saying that there's not a lot of bad news baked in. What are some levels you need to watch out for if we do get some bad news?
Well, we'll take a quick look at the chart because the daily looks like it's ready to go. If you look here, if you remember, we talked about Walmart just to show you how you could even time something like this when it crossed this downtrend right around 53. Nice run, breaking to new highs. It does look a tiny bit extended on a daily, but if you go to the monthly chart, oh my goodness, look at the size of this massive, massive range. Stock went from, 15 to almost 70 in that decade, so it's taken a decade to absorb that entire huge move. So it does seem like it's ready to go, and if this gets going and the market stays strong, there's no reason why you can't see a move well above 75 for Walmart. So that's price appreciation and the dividend.
All right, so then let's go to oil. Like we were talking about earlier, want to hit on Exxon and Chevron, possibly two ways to play rising oil prices, both about $4 or $5 away from 52-week highs. Do their charts look like a Walmart ready to set up, ready to go?
They look a little different, but they do look strong, just like Walmart. We've had two buy prices on XOM. You look right here. It trades really well technically, which surprises me. Look at this. It's almost like sometimes when it's too easy. Look at this resistance that it cleared. When it cleared 74, you had a quick move to almost 83. Then you had another range when it held higher when it cleared. Now you have a little bit of a bull flag type pattern. You had the news out of Venezuela. So if it can get...
Yeah, but the one Venezuela news is going to be a little dicey, I think, because they were expecting billions of dollars worth of money from Venezuela after Venezuela took some of their oil fields in 2007, and they only got under $1 billion. Right. Just under 800 million. So I just wonder how the market's going to wind up absorbing that news today.
I guess they'll watch it closely because maybe some of the strength is attributed to that. But if it doesn't pull in even on that, that'll show you the real strength. So last time, you take a quick look here, we start getting above 86. There's no reason why XOM doesn't take out the highs, of late April, and you go quickly to the monthly chart. It's one of the strongest stocks out there, and if it does clear this area, there's nothing in its way for a while.
And Chevron, let's look at that chart real quick.
You know what? Jill talks about Chevron a lot. She thinks that growth is really good here. It's not as, it's not, I guess, as an old company like XOM, but you look right here, this chart does look like it's ready to take out these highs even faster than XOM. So above this 110 on a monthly chart, it looks really good. On a daily chart, it does look ready to go as well if it can start clearing this 109.
All right, let's go to some quick trades you're going to want to keep in your focus today. Let's start with an IBM and a McDonald's, sort of the two of the best stocks in 2011. IBM was up 25% for the year. McDonald's up 31% for the year. What do you do now? Is it time for profit taking in these two stocks?
I think IBM, you have to be a bit careful because you saw what happened with Oracle. I do think that it needs to get through the January earnings. If you're in it for the long term, stay in it. As a trade, it just had a rally back. I think people might start to sell that 186 to 190 area. And as far as McDonald's, wow, they say you can't be a stock picker and make a lot of money. With this one, if you are a stock picker, you know, you could eat filet mignons, not McDonald's hamburgers. But it has done really well. So what you want to do is you want to see in the beginning of a new year if they start to sell some of the
I was
winners.
going to say, perhaps they sell it and rotate into something else at this point.
Yeah, so I would watch this uptrend, exactly. You know, if it starts to break this area, perhaps it corrects a little bit. If you're not committed to McDonald's, watch 99.
And what about Amazon? Are we oversold here in Amazon?
Amazon's been a very weak stock for high beta, and there was a lot of sell setups. Last Thursday, we had a really massive reversal on Goldman Sachs downgrade, which is kind of funny. I do think that it has room to 185, 190 before you worry about whether or not you need to be, you know, on your toes with Amazon. But I don't think it's going to be a leader. It's going to be in a little bit of trouble. But it's been so battered and bruised that people might try and trade it from a long stance going into that 185, 190.
And then JP Morgan, just want to hit on it very quickly. You said you were long headed into today. Well, what's your strategy?
I have some, and I'm going to see if I could add some. Look at this chart real quickly. It looks pretty good. You know, it's holding higher, holding better than most banks. If it starts to clear this 34 area, there's no reason why, if they want to keep these banks strong, it can't get to at least 37.
And rounding it out, I want to go to Green Mountain Coffee, trading in that tight range. What are traders doing with this stock?
It's a very, very tight range. I think below 34, they're going to short it, or below 37, maybe get a short squeeze.
All right, and then we just want to wrap up the day here talking about gold and silver. Now, gold came under pressure at the end of the year, did have a solid rally on Friday, a big bounce off of that 1535 level. Since 2001, gold has averaged a 3% gain in the first quarter. That would take us at current levels to about 1637. What do you make of gold right now?
I think you just said it. I don't even have to say it. It's oversold enough. It got battered and bruised enough that you could see some kind of squeeze up to about 1630, 1640. I was on Street Science Thursday, and I'm like, you know, it looks like it capitulated. If I were you, I would cover your gold here. And he's like, well, do you think you need to buy some? I'm like, I do still think we could see lower prices than last week's low at some point in 2012. But for a trade oversold, I think we can get back to that 1630, 1640. And if you look at the GLD, really, you know, I think that there's room for this to bounce probably to this zone, and then once you get to this zone, it's going to be, you know, hard for gold to really regroup that or recoup it.
Recoup it. There you go.
There you go.
All right, well, that's it for us for today. Happy New Year, everybody, and happy trading. I'm Alex Steele from The Street.